Welcome to this explainer where we're going to completely break down the absolute tidal wave of policy changes the Reserve Bank of India just unleashed in February 2026. If you've been watching the markets at all lately, you know the RBI has been incredibly busy. And look, they aren't just tweaking interest rates on the margins anymore. They are fundamentally rewiring the Indian economy. We're talking about changing how massive corporate empires are bought, how real estate is funded, and literally how your own bank account is protected from hackers. It's a total overhaul. So today, we're going to unpack exactly what all this means for the broader country's future and, of course, for your wallet. Let's just jump right in.
We've carved this massive update into 5 main pillars. Just doing a quick flyby of our roadmap here, we're going to start with a big macro picture and rates. Then look at how they're deepening financial markets. From there, we'll hit some really interesting shifts in real estate, specifically REITs, followed by new M&A rules, and finally we'll wrap up with digital payments and consumer protection.
All right, let's kick things off with our first section. We really have to start with the headline grabbers: inflation, interest rates, and system liquidity. Because really, this is the absolute foundation that the rest of the economy gets built on.
So, the big news? The RBI is keeping the repo rate steady at 5.25% and maintaining a neutral stance. Now, to really put that into context, remember the wild ride of 2025? We saw a rapid 125 basis points of rate cuts. This pause right here at 5.25% is a crystal clear signal. They're shifting away from that aggressive easing and moving into a period of policy consolidation. Basically, they're hitting the pause button to let those previous cuts actually absorb into the system before they make their next move. And you can see exactly why they're doing this when you listen to RBI Governor Sanjay Malhotra. He said, and I quote, "The economy is in a good spot with strong growth and low inflation." And you know what? The data completely backs him up. India's GDP growth is currently projected at a very robust 7.4% for FY26. What that tells us is the economy is expanding so healthily on its own that the central bank can easily support this lower for longer interest rate environment without having panic attacks about immediately stoking inflation. They've got breathing room, and they're using it to fuel long-term growth.
Now this number right here is honestly staggering. It shows the sheer scale of excess liquidity just sitting in the system. Banks have parked an unbelievable 4.47 lakh crore rupees in the RBI's Standing Deposit Facility, or SDF. You can basically think of the SDF as a giant, risk-free parking garage for extra cash. Instead of aggressively lending that money out to businesses or everyday consumers, banks are just leaving it parked there. It's a massive mountain of capital just waiting on the sidelines for the right opportunity.
And what's super fascinating is how that liquidity landscape is playing out in the short-term borrowing markets. Because things are tight beyond the overnight markets, banks are actually getting pushed into the certificate of deposit, or CD market, to fund themselves. But check out these gradual rate drops, especially on the shorter end, like that 1-month rate plunging almost 50 basis points. What's happening is the RBI is subtly allowing these rates to soften to help with monetary transmission, which is really just central bank speak for they want to make sure their lower rates actually result in cheaper loans for businesses and home buyers rather than getting bottlenecked at the top.
Okay, moving right along to our second pillar. Let's see how the RBI is actively trying to deepen India's corporate bond and debt markets. This whole section is basically about bringing a lot more sophistication and a lot more foreign capital into the financial system. So, to expand how credit risk is transferred, the RBI just rolled out draft guidelines on total return swaps, or TRS. The easiest way to think about a TRS is like a financial mirror. It's a derivative contract that lets players get the full return of a bond, so the coupon income plus any price jumps without actually having to own the underlying bond on their balance sheet. That is huge because it frees up bank capital to go do other things. Introducing this is a massive coming-of-age moment for India's corporate debt market.
But here's the catch, and it's an important one. While this is an incredibly powerful tool, it's regulated strictly. You and I, everyday retail investors, we are completely barred from playing in the TRS market. The RBI is basically keeping retail out of the casino here. On top of that, non-residents can only use these swaps to hedge, not to just blindly speculate. So the RBI is handing institutional market makers the tools to deepen the bond market, but they're keeping the guardrails bolted down tight to prevent systemic blowups.
And speaking of foreign capital, the RBI also made a massive flex by completely scrapping the 2.5 lakh crore rupee limit on the voluntary retention route, or VRR. Now, the VRR was originally designed to attract stable, long-term foreign money into India's debt markets. And clearly, it was such a home run that they had to just rip the ceiling off entirely. It's basically flashing a giant neon open for business sign to the rest of the world.
Before this, with over 80% of that old cap used up, investors were hitting a brick wall. So this shift completely removes that bottleneck by moving VRR investments under the general FPI limit, making it super smooth for foreign money to enter. But notice what didn't change. That mandatory 3-year commitment is still fully intact. The RBI is rolling out the red carpet for foreign money for sure, but only if that money is actually willing to stay and commit to India's long-term growth. No fair weather friends allowed.
Shifting gears over to our third pillar, we need to talk about real estate. Because the RBI is fundamentally changing how the real estate sector, and specifically real estate investment trusts, or REITs, secure their funding.
For the very first time, banks are now officially allowed to lend directly to REITs. This is a big deal. Because previously, if a REIT needed to raise cash, it had to jump through hoops, issuing bonds that were mostly bought up by mutual funds or NBFCs. It was a convoluted, heavily papered, and frankly expensive process that honestly just dragged down real estate growth. So why is direct lending such a game changer? Well, think about a REIT. Their investments are inherently super long-term, like taking a decade to build and lease out a massive tech park. But their previous funding sources, mostly shorter-term bonds. So they were constantly fighting this funding mismatch. Direct bank lending completely fixes this. It allows REITs to swap out expensive, short-term debt for much cheaper long-term bank loans. It smooths out their operations and dramatically slashes borrowing costs.
But of course, the RBI isn't blind. They know that unchecked real estate lending is basically how you brew a financial crisis. So, to prevent any sort of systemic bubble, these draft norms cap a single bank's exposure to 10% of its capital base. And looking from the other side, a REIT's total combined bank debt cannot exceed 49% of its actual value. It's a really smart balancing act, unlocking the capital that developers desperately need, while heavily insulating the banks from getting overly exposed to a real estate downturn.
And to make sure everyone plays by the rules, banks have to enforce some incredibly strict end-use monitoring. The absolute most critical one here, a complete zero-tolerance ban on using these bank loans to buy raw land. Why? Because buying raw land is pure speculation. The RBI wants this money flowing into completed income-generating projects that actually keep the economy humming. Plus, banks have to set up escrow accounts that guarantee cash flows don't magically get diverted elsewhere. It is very, very tight oversight.
All right, moving into our fourth pillar, let's look at the RBI's role in shaping major corporate buyouts and who actually runs these institutions. They are basically greasing the wheels for corporate M&A, but very much on their own terms.
The RBI is aggressively backing corporate expansion right now. First, they double the acquisition funding exposure limit from 10% to 20% of a bank's Tier 1 capital. But the real game changer is the shift to unlisted companies. Historically, banks were mostly handcuffed to funding buyouts of public listed companies. Now, they can bankroll the buyout of unlisted companies. Think massive private startups and unicorns. As long as they have a minimum net worth of 500 crore rupees, hold a solid credit rating, and are actually profitable, they are fair game for bank-funded buyouts.
And we are seeing this regulatory blessing happen in real time. Just recently, the RBI approved private equity giant Bain Capital's joint control acquisition of Manappuram Finance. That was an initial 18% stake that triggered a mandatory open offer for another 26%. It clearly shows the RBI is totally fine letting global capital take controlling stakes in key financial entities if it means better tech and better governance. We also saw them clear Vinay Tansey for a fixed 3-year term as CEO of Yes Bank, proving they are actively curating the leadership at the top of India's financial food chain.
Finally, let's bring all of this back down to earth, to you, the everyday consumer. Our fifth and final pillar is all about digital transactions and, way more importantly, how you are protected from fraud. Look, India's digital payment ecosystem isn't just growing, it's practically exploding. Check out the RBI's Digital Payments Index, which basically measures the heartbeat of nationwide digitization. It surged from around 493 in March to nearly 517 by September 2025. More people in India are swiping, scanning, and transferring money digitally than at any other point in history.
But look, with that kind of explosive growth comes an unavoidable spike in risk. And the RBI dropped a really sobering statistic. Roughly 65% of all digital frauds are happening in transactions below 50,000 rupees. We're not talking about some Ocean's 11-style corporate server heist here. The vast majority of this fraud is hitting everyday people. We're talking fake UPI QR codes, phishing texts, small-value scams that hit regular bank accounts hard.
So, to protect victims without totally crushing the banking system, the RBI introduced this brilliant skin-in-the-game compensation model. If you get hit by one of these small-value frauds, this framework covers up to 85% of your losses, capped at 25,000 rupees. Here's how it breaks down. You, the customer, absorb 15% so you stay vigilant. The bank takes a 15% hit, which forces them to build better security. And the remaining 70% bulk? That's covered by the 85,000 crore Depositor Education and Awareness Fund. It is a wildly pragmatic way to keep consumers trusting the digital economy.
We have covered a massive amount of ground today. From those sweeping macro rate holds and the deepening of the bond markets, to new REIT rules, M&A expansions, and finally, protecting your everyday digital transactions. As the RBI walks this tightrope, balancing really aggressive economic expansion with some seriously strict consumer protections, it really leaves us with one big question. Are we actually entering a new era of bulletproof financial stability in India, or are entirely new unseen risks just waiting around the corner? Thanks so much for joining me on this explainer, and definitely keep a close watch on how these policies actually play out in the real world.